Hello, everyone, and welcome back to our next chapter. First of all, congratulations to each and every one of you on completing Chapter 1. This is an exciting achievement, especially since you're just beginning your journey in accounting, and I'm proud of the hard work you've already put in. Learning accounting is a big step, and each chapter brings you closer to building a strong foundation that will help you understand business finances and so much more. You're doing amazing, so keep up the great energy. Today, we're diving into Chapter 2, titled Assets, Liabilities, and the Accounting Equation. This chapter is an essential one because it covers the very basics that make up all of accounting, so it's definitely worth getting excited about. Let me give you a quick overview of what we'll learn in this chapter. 1. Introduction to Accounting Fundamentals. We'll begin with the essentials, some key concepts and ideas that will help you feel more comfortable with accounting language and what it all means. 2. Assets and liabilities. Next, we'll learn about two very important terms, assets and liabilities. These are the resources a business owns and owes, and understanding them is key to knowing what the business is really worth. 3. The accounting equation. Here, we'll see how assets and liabilities connect with a concept called the accounting equation. This equation is like a basic rule in accounting, and it will help us see how a company's finances are balanced. 4. Accounts payable and accounts receivable. Then, we'll go into the money a business owes and is owed by others. This will help you understand how businesses track money coming in and going out. 5. Double entry bookkeeping. This is one of the most important skills in accounting. You'll learn how every transaction has two sides to keep the books balanced. 6. Capital expenditure and revenue expenditure. Lastly, we'll look at two different kinds of spending, capital and revenue. Understanding these will help you see the difference between spending for long-term growth versus day-to-day costs. By the end of this chapter, you'll have a strong understanding of these key topics, and they'll be a big help as we move forward. Let's dive in, keep up the motivation, and make the most of this chapter. All right, let's break this down step by step so it's much easier to follow. I'll keep it simple and straightforward to help you feel confident about what these paragraphs are really saying. Starting with double entry bookkeeping. In accounting, double entry bookkeeping is one of the most important ideas to understand. Think of it as the backbone of accounting because it's the method used to record every single business transaction. When we say double entry, it simply means that every financial transaction affects at least two accounts, not just one. For example, if a company buys equipment, it will increase its assets because they now have the equipment and decrease its cash because they paid for it. This way, the books always balance. So this chapter will introduce you to these double entry principles, which work for both cash and credit transactions. Whether a company is paying immediately with cash or agreeing to pay later on credit, the double entry system is applied. By learning these basics, you'll get a strong foundation in accounting. Why these basics matter for your learning. The first few chapters of your course, chapters 1 to 4, are all about these fundamental ideas in accounting, especially double entry bookkeeping. These chapters are designed to give you the building blocks of accounting knowledge. It's essential to understand the basics presented here, as they'll help you handle all the topics that follow, including financial accounting. Think of these chapters as your foundation. If you understand them well, the rest of accounting will be easier to grasp. Exam tip: why you need to master double entry. In your exams, questions about double entry bookkeeping are very common and are often asked in multiple choice format. Having a good grasp of this topic will make answering these questions easier and will help you feel more prepared. Plus, understanding double entry and the basics of accounting will help you later on when you learn about more practical accounting tasks like handling cash, credit, and payroll transactions in other parts of the course. So, stay focused as we go through these basics. They're going to set you up for success, not just in your exams, but also in understanding real-world accounting. All right, let's break this sentence down as if we're sitting together in a classroom. A business owns assets and owes liabilities. Let's start with the two new words here, assets and liabilities. 1. Assets. These are things that a business owns. Think of assets as anything valuable that belongs to the business and can help it make money. For example, a business might own things like cash, equipment, buildings, or vehicles. Just like you might own a phone or a computer, a business has its own valuable items too. Those are called assets. 2. Liabilities. These are things that a business owes. Liabilities mean the business has borrowed money or needs to pay back money at some point. For instance, if the business took out a loan or needs to pay suppliers for goods it received, those are its liabilities. So, liabilities are like the business's debts or what it owes to others. So, in simple words, we can say, a business has things it owns, assets, and things it owes, liabilities. This is a basic idea that we'll use often in accounting. It's the starting point for understanding a business's financial situation. The things a business owns give it value, and the things it owes are what it needs to pay back. Does that make sense? Imagine your own things you own versus things you owe, and then think about it from a business's point of view. That's the essence of assets and liabilities. All right, let's talk about what we mean by assets in very simple terms, just like we're sitting in a classroom together. What are assets? First, assets are simply things that belong to a business and help it operate. Think of assets as the tools and resources a business uses to make money and keep things running smoothly. Imagine if you were starting your own business. You would need things like a computer, maybe a car, cash, or even some goods to sell. All these things would help your business operate and grow. Those items would be your assets. Two types of assets. There are two main types of assets. 1. Non-current assets. These are assets that the business plans to keep for a long time. They're usually bigger items that aren't quickly used up. For example, machinery, equipment used for manufacturing or production. Office premises, the building or space where the business operates, like an office or a factory. 2. Current assets. These are assets that the business will likely use up, sell, or turn into cash within a year. Current assets include inventory, goods that the business has in stock waiting to be sold to customers. Accounts receivable, money owed to the business by customers who bought on credit, meaning they'll pay later. Cash, money the business has on hand in the bank or ready to use. Examples of assets. To make this even clearer, here are some common examples of assets that you might find in a business. Factories and office buildings, places where work happens or products are made. Warehouses, buildings where goods are stored. Delivery vans and lorries, vehicles used to transport goods or services. Machinery and equipment, machines that help with production or operations. Computers and office furniture, basic equipment that keeps the office functioning. Cash, money available for use in the business. Goods held in store inventory, products waiting to be sold to customers. Raw materials and components. These are the materials a manufacturing business might keep to make products. In summary, to sum it up, an asset is anything valuable that the business owns or can use to run the business. Assets help the business make money and keep things running day to day. When we understand assets well, we get a clearer picture of what the business owns and how it's able to operate. Hope that makes sense. Remember, assets are simply resources the business owns to help it succeed. All right, now let's look at non-current assets and current assets in more detail, just like we're continuing our lesson together. Non-current assets. First, let's talk about non-current assets. These are assets that a business keeps and uses for a long time. Think of non-current assets as the big items or long-lasting resources that help a business run for years. Imagine a business owns an office building. This building is used by the staff, maybe as a workspace, and it could be owned for many years without needing to be replaced. Similarly, think about machinery in a factory. Machinery is also a non-current asset because it can last a long time, sometimes many years, before it needs repairs or replacement. Non-current assets are usually expensive and are intended to last, so the business doesn't buy or sell them frequently. They're more like investments that help the business operate for the long haul. Examples of non-current assets: buildings and office spaces, machinery and equipment used in production, vehicles like trucks or delivery vans that the business owns, furniture and large office equipment. These are assets that stick around in the business for a while, supporting long-term operations. Current assets. Now let's look at current assets. These are assets that a business only holds for a short time, typically less than a year. Current assets are usually things that a business plans to sell, use up, or turn into cash quickly. Because they don't last long, they move in and out of the business more frequently. For example, think about a newsagent's shop that sells newspapers and magazines. Newspapers have to be sold the same day because they quickly lose value after that. Magazines and weekly publications also need to be sold quickly, or they become outdated and harder to sell. These are examples of current assets because they only stay in the business for a short period before they're sold. In other businesses, inventory, the goods they sell, and accounts receivable, money customers owe the business but will pay soon, are also current assets. The faster a business can sell these goods and collect payment, the more money it makes. Examples of current assets: cash, money that the business has available right now. Inventory, goods waiting to be sold to customers. Accounts receivable, money owed to the business by customers who will pay soon. So, to wrap up, non-current assets are long-lasting and help run the business for years, while current assets are short-term and move in and out of the business quickly, helping it make money in the short run. Both types are important for the business, but serve different purposes. Does that make it clearer? Just remember, non-current assets last longer and current assets are short-term. This will be very useful as we move forward with more accounting concepts. All right, let's dive into liabilities now. Just like we did with assets, let's go through what liabilities mean in a simple way. What are liabilities? Liabilities are simply the amounts of money that a business owes to others. In other words, liabilities are debts that the business has to pay back at some point in the future. These could be amounts owed to a bank, suppliers, or even the government. In accounting, we use the word liabilities to describe all these different kinds of debts. Whenever a business has borrowed money or has an outstanding bill, it's a liability. Examples of liabilities. To make this easier, let's look at some common examples. 1. Bank loans or bank overdrafts. Imagine a business takes out a loan from a bank. The business will eventually have to pay this money back, along with any interest charged by the bank. Until it is paid off, this loan amount is a liability. Similarly, if a business has a bank overdraft, which means it has used more money than what it has in its bank account, the amount overdrawn is also a liability. 2. Amounts owed to suppliers, also called accounts payable. Sometimes, a business buys things it needs on credit rather than paying right away. Let's say a boat builder buys timber, wood, from a supplier to build boats. The supplier agrees that the boat builder doesn't have to pay immediately, but can pay later. Until the boat builder pays for this timber, the amount owed to the supplier is a liability. We often call this type of liability accounts payable because it is money the business owes to suppliers who have provided goods or services. 3. Taxes owed to the government. A business must also pay taxes on its profits. However, there is usually a delay between when the business earns its profit and when it actually pays the tax. During this time, the amount of tax that needs to be paid is a liability to the government. The government becomes the account payable until the tax bill is settled. Why are liabilities important? Liabilities are essential because they tell us what the business owes and help us understand the full financial picture of the business. Just like a person might have a loan or credit card debt to pay back, a business has its own debts, and these need to be carefully managed. So, in summary, liabilities are what the business owes to others. They include things like bank loans, accounts payable to suppliers, and taxes owed to the government. Knowing the total amount of liabilities helps us understand how much debt the business has and how much it needs to pay back in the future. Hope that makes it easier to understand. Remember, liabilities are simply the business's debts, amounts it owes to others. This will be very useful as we continue with more accounting concepts. Welcome, students. I'm so glad to have you here today for another step forward in your accounting journey. Congratulations on making it this far. Today, our focus will be on a very important topic, the accounting equation. This equation is like the foundation or the heart of all accounting principles, and it helps us see how every business transaction affects the company's finances. But before we dive into this powerful tool, we need to understand a few key accounting concepts that are essential to grasp before we can fully appreciate the accounting equation. These concepts will give us a strong foundation and make the equation much clearer when we get to it. So, let's start with these building blocks and make sure we have a solid understanding before moving on. All right, students, let's talk about a key concept in accounting called an account. Understanding what an account is will make all our future lessons clearer. What is an account? Think of an account as a record or folder where we keep track of specific financial information. It's like having separate drawers in a filing cabinet where each drawer holds details of different types of business activities. Whenever there's money coming in or going out, we need to put that information in the correct drawer account so that we can see where the money is coming from and where it's going. Each account helps us organize financial information so we can easily check, for example, how much cash the business has, how much the business owes, what the business owns, how much revenue the business has earned, how much the business has spent on various expenses. Example of an account. Let's say you're running a small bakery and you need to track cash. You'd have a cash account where every time you receive money from selling bread, for example, or spend money to buy flour or pay rent, you make a note in the cash account. Over time, this cash account will show you how much cash you have available. Now, imagine you want to track how much you owe to suppliers. You'd create a separate account called accounts payable, where you record any amounts owed for things you bought on credit. This way, each account gives you specific information without getting mixed up with other financial details. Types of accounts in accounting. In accounting, we typically group accounts into 5 main types. 1. Asset accounts. Assets are things the business owns or controls that have value. Examples: cash, accounts receivable, money owed to the business by customers, inventory, items in stock, equipment, and buildings. 2. Liability accounts. Liabilities are amounts the business owes to others. Examples: accounts payable, money owed to suppliers, loans payable, money borrowed from a bank, and tax payable, taxes owed to the government. 3. Equity accounts. Equity represents the owner's interest or claim in the business after all liabilities are subtracted from assets. Examples: capital, owner's initial investment and retained earnings, profits that are kept in the business. 4. Revenue accounts. Revenue is income earned from selling goods or providing services. Examples: sales revenue, income from sales, service revenue, income from services provided, and interest income, interest earned on investments. 5. Expense accounts. Expenses are costs the business incurs to operate and earn revenue. Examples: rent expense, utility expense, like electricity and water, salary expense, and advertising expense. Why accounts are important. Each of these accounts gives us specific information about different parts of the business. For example, asset accounts help us know what the business owns. Liability accounts show us what the business owes. Revenue accounts tell us how much money we're bringing in. Expense accounts tell us how much money we're spending. By organizing financial information into these accounts, we can easily analyze how the business is performing and make informed decisions. Quick example of using different accounts. Imagine you own a coffee shop. When you sell a cup of coffee for $5, you'd record it in the sales revenue account. If you pay $3 for the coffee beans, you'd record that in the expense account under supplies expense. The $2 profit is part of your equity, so every transaction affects at least two accounts. This way, you can track every dollar earned, every dollar spent, and how it affects the overall business. In our upcoming lessons, we'll go deeper into each type of account and see how they connect in the accounting equation. All right, students. Now that we've covered what an account is, let's dive into one of the most important types of accounts in accounting, the asset account. What is an asset account? An asset account is used to record and track everything a business owns or controls that has value and will bring future benefits. Think of assets as resources that help the business run and grow. When a business owns something valuable, it records this in an asset account. For example, cash in the bank, equipment, inventory, and even money owed by customers, called accounts receivable, are all assets. Each of these valuable resources gets its own sub-account under the asset category so that we know exactly what the business owns and can easily keep track of each item. Common types of asset accounts. Let's look at the main sub-accounts that fall under the asset account. Here's a list of the most common asset accounts you'll see in accounting. 1. Cash. This is money that the business has on hand in the bank or in petty cash. 2. Accounts receivable. This is money owed to the business by customers who bought goods or services on credit. It represents future cash that the business expects to receive. 3. Inventory. This account includes goods and materials the business owns and intends to sell. For example, if you own a clothing store, your inventory would include the clothes you plan to sell to customers. 4. Supplies. Supplies are items used in the day-to-day operations of the business, like office supplies or cleaning supplies that aren't meant for resale. 5. Prepaid expenses. These are expenses that the business has paid in advance, like insurance or rent. It's an asset because the business will receive benefits from it in the future. 6. Land. This includes land that the business owns. Unlike most assets, land doesn't wear out or lose value over time. 7. Buildings. Buildings owned by the business are recorded in this account. Over time, buildings may lose value. We call this depreciation, but they still hold substantial value. 8. Equipment. This includes all machinery, computers, tools, and other equipment the business uses in its operations. 9. Vehicles. If the business owns any vehicles, such as delivery vans or trucks, they are recorded in this account. 10. Furniture and fixtures. This account includes things like desks, chairs, and shelves used in the business's offices or stores. 11. Intangible assets. These are assets that don't have a physical form but still hold value. Examples include patents, copyrights, trademarks, and goodwill. They help the business in unique ways but aren't physically touchable. 12. Investments. Sometimes businesses buy stocks or bonds as investments. These investments are also considered assets since they are expected to bring future financial benefits. 13. Accumulated depreciation. This account tracks the total amount of value that non-current assets, like buildings or equipment, have lost over time. It's a way to keep track of how much of the asset's value has been used up. Why these sub-accounts matter. Each sub-account gives us specific information about different kinds of assets the business owns. By separating assets into these categories, we can see exactly where our resources are and understand how they contribute to the business. For example, cash helps pay bills and employees. Inventory represents goods to sell and earn revenue. Equipment helps in production and business operations. Understanding these subaccounts gives us a clear picture of everything the business owns and how each asset supports the business's goals. All right, students. Now that we've looked at assets, let's move on to something equally important: capital. Capital is a key part of the equity section in accounting. What is capital? In simple terms, capital is the amount of money or other resources that the business owners have invested in the business. Think of it as the owner's financial stake in the company. When the business starts, the owner puts in money or other valuable items, like equipment or vehicles, to get things going. This initial investment and any future investments make up the capital of the business. Capital is recorded in an equity account because it represents the owner's share of the business. It's essentially what the business owes back to the owner since they have put their own resources into it. Why is capital important? Even though it's technically a subaccount under equity, capital is crucial because 1. It represents ownership. Capital shows how much of the business actually belongs to the owner after all debts are paid. 2. It shows financial health. Higher capital often means the owner has more invested in the business, showing strong support from the owner. 3. It affects business growth. More capital gives the business more resources to grow and expand, which is essential for success. Accounts under equity. Equity represents the owner's stake in the business, and it includes more than just capital. Let's look at the other key accounts that fall under the equity category. 1. Capital account. This is the primary account where the owner's investment is recorded. 2. Retained earnings. Retained earnings are profits that the business has made over time and has decided to keep rather than distribute to owners. It's like a savings account for the business and can be used for future investments, growth, or paying off debts. 3. Drawings or withdrawals. Drawings are amounts that the owner takes out of the business for personal use. This reduces the equity because it's money taken from the business by the owner. For example, if the owner takes some cash from the business account for personal expenses, it's recorded in the drawings account. 4. Dividends for corporations. If the business is a corporation, it may distribute a portion of its profits to shareholders as dividends. Dividends reduce the business's retained earnings and represent the portion of profits paid out to shareholders. 5. Additional paid-in capital for corporations. This account records any extra money shareholders pay when they buy shares from the company above the share's nominal value. It increases the equity and represents additional investment from shareholders. 6. Common stock and preferred stock for corporations. For corporations, these accounts represent the ownership shares that have been issued to investors. Common stock is usually held by regular shareholders, while preferred stock offers special privileges, but often without voting rights. Each of these accounts helps us track the owner's or shareholder's interest in the business, showing what part of the business's value actually belongs to them. Together, these accounts give a full picture of the owner's or shareholder's stake in the company and help us understand the business's financial structure. By understanding capital and other equity accounts, you'll get a clearer picture of who owns what in the business and how ownership can change as profits are made, money is invested, or withdrawals are taken. All right, students, now let's talk about another important part of the accounting system: liability accounts. What is a liability account? A liability is essentially a debt or obligation that the business owes to others. Liabilities arise when the business borrows money, buys goods or services on credit, or incurs expenses that it hasn't paid yet. In simple terms, liabilities are the amounts the business owes to other people or organizations, such as banks, suppliers, or tax authorities. Liability accounts help track these obligations. Each type of liability is recorded in its own account, so we can easily see who the business owes money to and how much. Why are liabilities important? Liabilities are crucial to understand because 1. They represent business debts. They show how much of the business's assets are financed by others, not the owner. 2. They affect cash flow. Managing liabilities properly is essential to avoid cash flow issues and keep the business financially healthy. 3. They show financial health. Keeping track of liabilities helps us understand the financial structure and obligations of the business. Types of liabilities. Liabilities are generally divided into two main types based on how soon they need to be paid. 1. Current liabilities. These are obligations the business has to pay within a year. They include things like bills, loans, and salaries that are due soon. 2. Non-current liabilities. These are long-term obligations that are due in more than a year. Examples include long-term loans and bonds. Let's go through each of these with examples. 1. Current liabilities. These are debts that need to be paid within a year and include accounts payable, money the business owes to suppliers for goods or services it has received but not yet paid for. For example, if the business buys raw materials from a supplier and agrees to pay in 30 days, this is recorded in accounts payable. Short-term loans or notes payable, loans that must be repaid within a year. For example, if the business borrows money for a short period to cover temporary expenses, this loan is recorded as a short-term liability. Accrued expenses. Expenses that the business has incurred but hasn't paid yet, like wages or utilities. For instance, if employees have worked but their salaries are due next month, the business records this as an accrued expense. Unearned revenue or deferred revenue. This is money the business has received in advance for goods or services it hasn't yet delivered. For example, if a business is paid up front for a service it will provide in the future, that amount is recorded here until the service is completed. Current portion of long-term debt. Sometimes, part of a long-term loan has to be paid within the year. This portion is recorded as a current liability. 2. Non-current liabilities. These are obligations that will be paid over a longer period, typically more than 1 year. Common examples are long-term loans or notes payable, loans that the business has to repay over several years. For example, if the business takes out a loan to purchase equipment, this loan may be paid back over 5 years, making it a non-current liability. Bonds payable. If the business issues bonds to raise money, the bondholders are creditors. The amount owed to bondholders is recorded as a long-term liability. Mortgage payable. A specific type of loan secured by property, like real estate. The mortgage is paid back over several years, making it a non-current liability. Deferred tax liability. Sometimes the business delays paying certain taxes due to timing differences between tax and accounting standards. The tax that is due in the future is recorded here. Summary of liability accounts. So here's a quick list of all the main accounts under liabilities. Current liabilities. Accounts payable. Short-term loans or notes payable. Accrued expenses. Unearned revenue. Deferred revenue. Current portion of long-term debt. Non-current liabilities. Long-term loans or notes payable. Bonds payable. Mortgage payable. Deferred tax liability. Each of these accounts helps track what the business owes and when it's due. By understanding liabilities, you get a clear picture of the obligations that the business must fulfill in the short term and over the long term. Remember, liabilities are essential for business operations, but managing them carefully is crucial for financial health. Let's take a closer look at income accounts and how they differ from revenue accounts. What is an income account? In accounting, income refers to all sources of earnings that contribute to a business's financial gain. Income accounts include revenue, but also capture other types of earnings that aren't part of a business's core sales or main operations. This broader view includes items that support or supplement revenue, but come from activities outside of the primary business operations. In other words, while revenue focuses on the money earned from regular sales or services, income includes both revenue and additional earnings that don't come directly from the business's main products or services. Why is income different from revenue? The main difference is that revenue is earned from the business's primary activities, like a bakery selling bread or a consulting firm providing advice. Income, however, includes revenue plus any other earnings, such as profits from investments, sales of old equipment, or other non-core activities. This distinction helps businesses see not just how much they're making from their main operations, revenue, but also from other sources, additional income, which can be important for managing finances. Types of income accounts that aren't revenue. Below are some common types of income that appear in an income account but are not classified under revenue. 1. Gain on sale of assets. When a business sells assets like equipment, vehicles, or buildings for a profit, it records the profit as a gain rather than revenue. For example, if a company sells an old delivery van for more than its book value, the extra amount earned over its value is a gain on sale of assets. 2. Interest income. When a business earns interest from investments, such as money held in savings accounts or from lending money to others, this is recorded as interest income. This income is separate from core business revenue. 3. Dividend income. If a business owns shares in other companies and earns dividends, it records this as dividend income. For example, if a retail business owns stock in another company and receives a dividend, this income isn't revenue because it's not related to the main business of selling products. 4. Rental income from property. If a business rents out part of its space and earns rental income, this can be recorded as income. However, if renting property is part of the business's main activities, e.g. a real estate company, this would be considered revenue. 5. Other gains, like currency exchange gains. Sometimes businesses make gains from currency exchanges if they operate internationally. For instance, if a company buys products from another country and the exchange rate changes favorably, the difference can be recorded as a currency exchange gain. Summary of non-revenue income accounts. To keep it clear, here's a list of income accounts that do not fall under revenue. Gain on sale of assets, interest income, dividend income, rental income from property, if not part of the core business, currency exchange gains, other miscellaneous income. These accounts reflect additional ways a business can earn income aside from its primary business activities. By tracking both revenue and non-revenue income separately, businesses can understand all sources of income and plan effectively for future expenses and growth. So, while revenue is central to understanding how well the main business operations are performing, income shows the complete picture of all money coming in, including one-time or non-operational gains. Understanding these differences is crucial for accurately interpreting financial statements and assessing a business's full financial health. All right, students, now let's dive into an essential part of any business's financial picture, the revenue account. What is a revenue account? Revenue represents all the income a business earns from its normal operations. It's the money the business makes from selling its products or services. Whenever the business earns money, it is recorded as revenue. Think of revenue as the lifeline of the business. Without money coming in, the business wouldn't be able to cover its expenses, grow, or make a profit. Revenue is often referred to as sales or income in everyday terms. Why is revenue important? Revenue is essential because 1. It reflects business success. High revenue generally means the business is doing well in terms of sales. 2. It funds business operations. Revenue provides the cash the business needs to pay bills, invest in new opportunities, and grow. 3. It leads to profit. When a business subtracts expenses from revenue, it gets its profit, or net income. So, revenue is the starting point for determining how much the business is actually earning after costs. Types of revenue accounts. In accounting, there are different types of revenue accounts that record various sources of income for a business. Here are the main ones. 1. Sales revenue. This is the income earned from selling goods or services. For example, if a retail store sells clothes, the money it receives from each sale is recorded as sales revenue. 2. Service revenue. Some businesses earn income from providing services instead of selling goods. For example, If a cleaning company charges a customer for cleaning services, the payment it receives is recorded under service revenue. Let's dive into the expense account and see what it covers. What is an expense account? An expense is any cost that a business incurs to run its daily operations. Expenses are necessary for generating revenue and keeping the business running smoothly. Expenses reduce a company's income because they are the costs associated with running the business, everything from paying rent to purchasing office supplies. In accounting, all expenses are recorded in expense accounts to keep track of where the money is going and to measure the profitability of the business accurately. Why are expenses important? Expenses are vital because they show what it costs to run the business. By knowing your expenses, you can control spending, identify unnecessary costs, and make decisions to improve profitability. For example, if a business is spending a lot on utilities, it might consider energy-saving methods to reduce these costs. Types of expense accounts. Expenses can be grouped into several categories, each representing a different type of cost the business may incur. Below are common types of expense accounts that businesses typically use. 1. Cost of goods sold, COGS. This is the cost directly tied to making or buying the products that a business sells. For example, a bakery's COGS would include the cost of ingredients like flour and sugar. 2. Rent expense. The cost of renting space for business operations. This could be for an office, warehouse, or retail store. 3. Salaries and wages. These are the expenses related to paying employees. It includes all wages, salaries, bonuses, and other compensation. 4. Utilities expense. This includes electricity, water, gas, and other utilities used by the business. 5. Supplies expense. The cost of office supplies and other small items needed for day-to-day operations. This could include paper, pens, printer ink, and cleaning supplies. 6. Insurance expense. This covers the cost of insurance policies, such as health insurance for employees, property insurance, and liability insurance. 7. Advertising and marketing expense. Money spent on advertising, promotions, and marketing efforts to attract customers. 8. Depreciation expense. The gradual decrease in value of long-term assets like buildings, machinery, and equipment over time. This expense reflects how much of an asset's value has been used up. 9. Interest expense. The cost of borrowing money. If a business has taken out loans, the interest paid on these loans is recorded here. 10. Travel and entertainment expense. Costs for business travel and meals with clients. This could include airfare, hotel stays, and other travel-related costs. 11. Professional fees. Payments made to external professionals like accountants, lawyers, or consultants. 12. Repairs and maintenance. Costs for repairing and maintaining equipment, buildings, or vehicles used in the business. 13. Office supplies. Similar to supplies expense, this includes items specifically for office use, like stationery, printer ink, and office furniture. 14. Miscellaneous expense. Any other small pay, irregular expenses that don't fit into the categories above. These might include minor fees, subscriptions, or other small purchases. Summary of expense accounts. To summarize, here is a list of expense accounts typically used by businesses. Cost of goods sold, COGS. Rent expense. Salaries and wages. Utilities expense. Supplies expense. Insurance expense. Advertising and marketing expense. Depreciation expense. Travel and entertainment expense. Professional fees. Repairs and maintenance. Office supplies. Miscellaneous expense. Tracking these expense accounts helps businesses understand where their money is going, control costs, and make informed financial decisions. By carefully managing expenses, businesses can protect their profits and strengthen their overall financial health. Let's look at expenditure and understand how it's different from an expense in accounting. Both terms refer to costs, but they're used in different situations. So let's explore them in simple terms. What is expenditure? Expenditure refers to the total amount of money spent by a business to buy goods or services, or to make investments for long-term benefits. Think of it as any outflow of money or resources from the business. Expenditure can be short-term or long-term. 1. Short-term expenditure. This is money spent on things that will be used up within the year, like office supplies or monthly rent. These are also called revenue expenditures. 2. Long-term expenditure. This is money spent on things that will last and benefit the business for several years. For example, buying a building, machinery, or a vehicle is a long-term expenditure. This type is often called capital expenditure. Key types of expenditures. In accounting, expenditures are divided into two main categories. 1. Capital expenditure. Money spent on assets that will be used over many years. Example, buying a delivery truck or new office furniture. 2. Revenue expenditure. Money spent on daily operational costs to keep the business running. Example, paying for electricity or wages for employees. How is expenditure different from expense? The main difference between expenditure and expense is timing and purpose. 1. Expenditure is the action. Expense is the accounting result. When a company spends money, it's called an expenditure. This could be to buy supplies, pay for repairs, or invest in new equipment. Once the expenditure is recorded as an ongoing cost for the year, it becomes an expense in the financial statements. 2. Short-term versus long-term benefit. Expense refers to costs that are used up within the current accounting year. For example, rent payments or monthly utility bills are expenses because they benefit the business only within a short period. Capital expenditure, on the other hand, benefits the business over a longer period. Buying a machine, for example, is an expenditure that will help the business for many years. 3. Impact on financial statements. Expenses directly impact the business's profit and loss statement or income statement because they reduce the business's profit for that year. Capital expenditures are shown on the balance sheet as assets, and their cost is spread over many years through a process called depreciation, gradually writing off the asset's value. Examples of expenditures and expenses. Here are some examples to show the difference between expenditures and expenses. Capital expenditure example. A company buys a computer system for $5,000 that it will use for the next 5 years. This is an expenditure. In each year, only a part of that will be recorded as an expense under depreciation. Revenue expenditure example. A company spends $500 on office supplies. This is an expenditure, but because the supplies are used up within the year, the full $500 is recorded as an expense in the same year. Let's talk about profit and loss, two very important concepts in accounting. They show us how well a business is doing financially by comparing its income and expenses. While income and expense are individual figures, profit and loss tell the overall result of a business's financial activities. Let's break this down in detail, in simple language, to make sure it's clear. What is profit? Profit is the money that a business keeps after all its expenses have been paid. In other words, it's the positive result of having more income than expenses. When a business makes a profit, it means the company has earned more money than it has spent, which is a good sign of financial health. Example of profit. Imagine a small bakery that earned $10,000 in a month from selling cakes and pastries. The bakery had expenses of $7,000 for ingredients, rent, employee wages, and utilities. To find the profit, we subtract the expenses from the income. So the bakery made a $3,000 profit that month. What is loss? Loss is the opposite of profit. It happens when a business's expenses are greater than its income. This means the company has spent more money than it earned, which can be a warning sign that adjustments may be needed. Example of loss. Let's go back to our bakery example. If the bakery earned only $6,000 in a month, but the expenses were still $7,000, in this case, the bakery had $1,000 loss for the month, meaning they spent more than they earned. How are profit and loss different from income and expense? To understand how profit and loss are different from income and expense, think of income and expense as building blocks. Here's how. Income is the total money a business earns from selling goods or providing services. It's a single figure showing earnings. 2. Expense is the total money a business spends on things like rent, supplies, and employee wages to operate. It's a single figure showing spending. Profit and loss are not just single figures. Instead, they are results or end totals after comparing the income with the expenses. Profit shows the positive result after income exceeds expenses. Loss shows the negative result when expenses exceed income. Think of income and expense as the parts and profit or loss as the result when we calculate them together. Key points to remember. 1. Income versus profit. Income is the total money earned by a business, while profit is the money left over after expenses are deducted from that income. 2. Expense versus loss. Expense is the total money spent on running the business, while loss is the result when expenses are greater than income. Why is understanding profit and loss important? Profit and loss are important because they tell us if a business is financially healthy. Knowing if there is a profit or loss helps businesses. 1. Make decisions about spending and saving. 2. Adjust prices or cut costs if needed. 3. Plan for future growth or find ways to reduce losses. Summary. Income is the money a business earns. Expense is the money a business spends. Profit is the extra money left after paying expenses, good for business. Loss means expenses are higher than income, a warning sign for business. Understanding these terms helps businesses know where they stand financially and make smart decisions. Let's talk about shareholders and stakeholders, two terms that are closely related to a business but have distinct meanings. Understanding the difference between these two is important because each group has different interests in a company. 1. Who are shareholders? Shareholders, also known as stockholders, are people or organizations that own shares in a company. A share is a small piece of ownership in the company, so when someone buys shares, they're actually buying a part of that business. This means shareholders are partial owners of the company. They have an interest in the company's success because owners, they benefit when the company does well. For example, if the company's value increases, so does the value of their shares. Shareholders may receive dividends, which are portions of the company's profits distributed to shareholders. They have certain rights, like voting in important company decisions, such as electing board members or approving major changes. Example of a shareholder. Imagine a person named Sarah buys shares in a tech company. Now, Sarah is a shareholder in that company. She owns a small part of it and benefits if the company grows and becomes more profitable. 2. Who are stakeholders? Stakeholders are individuals or groups who have an interest in a company's success but do not necessarily own shares in it. Unlike shareholders, stakeholders can include a wide variety of people who are impacted by the company's operations, even if they don't own a piece of it. Stakeholders include employees. Their jobs and income depend on the company's success. Customers. They rely on the company for quality products or services. Suppliers and vendors. Their business depends on the company buying their products or services. Creditors and lenders. These are banks or other entities that have loaned money to the company and expect it to be repaid. The community and environment. People in the area where the company operates may be affected by its actions, especially if it impacts local employment or the environment. Example of a stakeholder. Let's say a factory opens in a town, providing jobs to hundreds of residents. Even though most townspeople don't own shares in the factory, they are stakeholders because they are affected by the factory's operations. If the factory succeeds, it provides stable jobs and contributes to the local economy. Both shareholders and stakeholders are essential to a business, but their needs and interests can sometimes conflict. For example, shareholders might want the company to cut costs to increase profits and dividends, even if it means layoffs or reduced wages. Stakeholders, like employees, on the other hand, might be more concerned with job security and fair wages than with maximizing profit. A successful business needs to balance the needs of both groups. This is why companies often talk about corporate social responsibility, CSR. It's a way to show that they are considering the impact of their actions on all stakeholders, not just shareholders. In summary, shareholders are people who own shares in the company and have a financial interest in its success. Stakeholders include anyone affected by the company's actions, whether they own shares or not. Balancing the needs of both groups is crucial for the company's long-term success. Understanding the difference between these two terms can help you see the bigger picture of how businesses operate and the impact they have on various people and communities. Let me know if you'd like more examples or if there's anything I can clarify further. Let's talk about debit and credit, two of the most fundamental ideas in accounting. These terms can be a little confusing at first, especially because they're used differently in everyday life and in accounting. So let's break it down slowly and clearly. What are debits and credits? In accounting, debit, DR, and credit, CR, are terms used to record increases or decreases in different types of accounts. Think of them as tools that help us keep track of where money is coming from and where it's going. Every time a transaction happens, like a sale, a purchase, or paying a bill, we use debits and credits to show how that transaction affects the business's financial records. Key principle, the double entry system. Accounting uses a double entry system. This means that every transaction has two sides, a debit side and a credit side. For each transaction, you'll record both a debit in one account and a credit in another account. These two sides must always balance, meaning that the total amount of debits must equal the total amount of credits. This keeps the accounting records accurate. Debits and credits depend on the type of account. Different types of accounts behave differently with debits and credits. Here's a simple guide to help you remember. 1. Asset accounts, e.g., cash, equipment, accounts receivable. Debit equals increase, credit decrease. 2. Liability accounts, e.g., loans payable, accounts payable. Debit decrease, credit equal increase. 3. Equity accounts, e.g., owner's capital, retained earnings. Debit equals decrease, credit equals increase. 4. Revenue accounts, e.g., sales service income. Debit decrease, credit increase. 5. Expense accounts, e.g., rent expense, utility expense. Debit equals increase, credit equals decrease. Let's look at some examples to make this clearer. Example 1. Buying office supplies with cash. Imagine a business buys $100 of office supplies with cash. We need to record this in our accounts. 1. Cash is an asset and it's going down because we're spending it. So we credit the cash account by $100. 2. Office supplies is also an asset and it's going up because we're receiving supplies. So we debit the office supplies account by $100. Entry, debit office supplies $100, credit cash $100. This entry shows that one asset, supplies, increased while another asset, cash, decreased, and they balance each other. Example 2, borrowing money from a bank. Now imagine the business takes out a $500 loan from the bank. This affects two accounts. 1, cash, asset, goes up because we're receiving cash. So we debit cash by $500. 2, loan payable, liability also goes up because we now owe money to the bank. So we credit loan payable by $500. Why use debits and credits? The debit and credit system allows accountants to track where money is coming from and where it's going. By balancing each transaction with equal debits and credits, we can quickly see if the accounts are accurate. This system also prevents mistakes and helps catch errors because every entry needs to balance. A simple way to remember debits and credits. Here's a helpful tip. Dealer can help you remember which accounts increase with debits and which with credits. Dividends, expenses, assets. These three types increase with debits. Liabilities, equity, revenue. These three types increase with credits. In summary, debits and credits are used to record each financial transaction. Every transaction affects at least two accounts and must balance double entry system. Different types of accounts react differently to debits and credits. Take it slow and practice with examples. Once you start using debits and credits, it will become more natural, and you'll start to see the patterns. Remember, accounting is like learning a new language, so don't worry if it feels a bit tricky at first. Let me know if you have any questions, and I'll be happy to explain further. The accounting equation, a fundamental rule of accounting. The accounting equation is a basic rule that helps us understand the financial position of a business. This equation shows the relationship between what a business owns and what it owes. Here's the equation written out fully. Assets equals capital plus liabilities. Let's break down each part of this equation to make it simple. Assets are what the business owns, things like cash, equipment, and inventory. Capital is what the owner has invested in the business. Think of this as the owner's stake in the business, or what the business owes to its owner. Liabilities are what the business owes to others, like loans or bills it needs to pay. According to the accounting equation, the total of all assets must always equal the combined total of capital and liabilities. In other words, everything the business owns is either funded by the owner, capital, or borrowed from others, liabilities. This balance is essential in accounting. Why is the accounting equation important? The accounting equation is crucial because it keeps the business's finances balanced and accurate. It helps us see a clear picture of the company's financial health by ensuring that every transaction is recorded on both sides. This is why the equation is also known as the balance sheet equation, as it forms the foundation of the balance sheet, one of the main financial statements. Example, Neelam Sultan's flower business. On the 1st of July, Neelam Sultan decides to open a flower stall to sell flowers and potted plants. To start her business, she invests $2,500 of her own money as capital. 2. Applying the accounting equation. When Neelam puts $2,500 into the business, this money becomes an asset of the business. The business now has $2,500 in cash, which it can use to buy supplies or pay for expenses. At the same time, the business now owes this amount back to Neelam because she invested her own money into it. In accounting, we call this capital. Capital represents the owner's investment, which the business has to repay if it were ever closed down. So, here's how the accounting equation looks after Neelam's investment. Assets equals capital plus liabilities. $2,500 equals $2,500 plus 0. In this example, assets are $2,500, the cash in the business. Capital is also $2,500, the amount Neelam invested. Liabilities are 0 because the business has no other debts at this stage. As you can see, the equation is balanced because the assets, $2,500, are equal to the capital, $2,500, and there are no liabilities yet. Understanding the concept of capital as a loan from the owner. In accounting, we treat the business as a separate entity from the owner. This means that even though Neelam owns the business, her investment is seen as money the business owes back to her. If Neelam decided not to go ahead with the business would be responsible for returning the $2,500 to her. In accounting terms, the capital is treated as a form of liability to the owner, meaning the business owes this amount back to Neelam. As long as Neelam's money remains invested in the business, it is recorded as capital in the accounting equation. What happens next? This example is the first step in understanding the accounting equation. At this stage, we only have an initial investment from the owner, so the business only has assets, cash, and capital, with no other liabilities. As the business grows and starts to buy goods, sell products, or take loans, the accounting equation will still apply. Every transaction will change the amounts in assets, capital, or liabilities, but they will always remain balanced according to the accounting equation. Let's continue with Neelam's example to see how the accounting equation develops as she spends money on different assets and starts earning a profit. 3.2 example. Continued. Different assets. After investing her original capital of $2,500, Neelam makes a couple of purchases to prepare for her new flower business. 1. Purchasing a market stall. Neelam buys a market stall from Sanjay Patel for $1,800. This stall is now an asset because it's something the business owns and will use for trading. 2. Buying flowers and plants. She also buys flowers and potted plants from a supplier for $650. These are also assets because they are inventory that the business will sell to customers. 3. Remaining cash. After these purchases, Neelam has only $50 left in cash. This cash is part of her business's assets, though it's now a much smaller amount. Let's now update the accounting equation to reflect these purchases. Assets equals capital plus liabilities. Breaking it down, assets now include market stall, $1,800, flowers and plants, $650, cash, $50. Total assets, $2,500, capital remains $2,500, as this is still the total amount Neelam invested. Liabilities remain $0 because she hasn't borrowed any money or taken out any loans. So the equation still balances. $2,500 equals $2,500 plus 0. This shows us that Neelam's assets have changed form, from being all cash to being divided into different types of assets, the stall, inventory, and a small amount of cash. But the total value of assets still equals the total of capital and liabilities. 3.3 Example continued. Profit introduced. On July 3rd, Neelam has a very successful day selling her flowers and plants. Let's see how this sale impacts the accounting equation. 1. Selling flowers and plants for $900. Neelam sells all of her flowers and plants for a total of $900 in cash. 2. Calculating profit. The flowers and plants she sold originally cost her $650. Since she sold them for $900, she has made a profit. Here's how to calculate it. Profit equals sales minus cost of goods sold. Profit equals $900 minus $650. Profit equals $250. So, Neelam has earned $250 in profit from her first day of trading. 3. Adding profit to capital. In accounting, profit is treated as an increase in capital as long as it is kept in the business and not paid out to the owner. In this case, Neelam is not withdrawing her profit, so it will be added to her original capital. Updating the accounting equation with profit. Let's see how the accounting equation looks after including this profit. Assets equals capital plus liabilities. Breaking it down again. Assets now include market stall, $1,800, unchanged. Cash, $50 remaining cash, plus $900. Sales equals $950. Total assets, $2,750. Capital now includes original capital introduced, $2,500. Retained profit, $250. Total capital, $2,750. Liabilities remain $0 because there are no loans or debts. So the updated equation is $2,750 equals $2,750 plus 0. This update shows that the profit Neelam made has increased her total assets, now with additional cash, and her total capital, now with retained profit. Expanded accounting equation with retained profit. With the introduction of profit, the accounting equation can be expanded to show capital in more detail. Assets equals capital introduced plus retained profits plus liabilities. Or in numbers, $2,750 equals $2,500 plus $250 plus 0. Summary. Assets changed as Neelam purchased different items for her business. Her assets now include a market stall, inventory, and some cash. Capital increased as Neelam retained her profit from the day's sales. Liabilities remain 0 because Neelam hasn't borrowed any money. The accounting equation has stayed balanced at each step, demonstrating that assets equals capital plus liabilities holds true even as the business grows and makes sales. This is the power of the accounting equation. It keeps the financial position clear, no matter how many transactions are made. Understanding how Neelam Sultan's net assets increased. All right, let's look at what happened in Neelam Sultan's business on July 3rd. We'll see how her net assets, or in simple terms, the value of her business, changed from the beginning of the day to the end of the day. Net assets are the difference between what the business owns, its total assets, and what it owes, its total liabilities. Basically, net assets are like the owner's piece of the business. In Neelam's case, we're told she has no liabilities or debts, so her net assets are simply everything the business owns. Let's walk through this day step by step. Step 1. Net assets at the beginning of the day. At the start of the day on July 3rd, Neelam's business has net assets of $2,500. This amount, $2,500, represents the capital Neelam has put into her business up until this point. Since it's the beginning of the day, there hasn't been any activity yet, so there's no profit earned or retained in the business at this moment. To summarize, beginning of the day net assets are $2,500. This amount is entirely made up of capital that Neelam has put into the business. Step 2. Net assets at the end of the day. Now, let's jump to the end of the day on July 3rd. By this point, Neelam's net assets have increased to $2,750. This is the new value of her business at the end of the day, and it's higher than it was in the morning. So, what's happened here? This increase means that Neelam's business has earned some profit over the course of the day. Step 3. Calculating the increase in net assets. To see exactly how much the net assets have increased, let's look at the difference between the end of the day net assets and the beginning of the day net assets. Here's how we figure it out. Take the end of the day net assets, which are $2,750. Then subtract the beginning of the day net assets, which were $2,500. This leaves us with $250 as the increase in net assets. So Neelam's net assets went up by $250 over the course of the day. This increase of $250 represents the profit her business made during the day. Since she didn't take any of that profit out, it's still in the business, so we call it retained profit. This retained profit is now part of her total net assets at the end of the day. Step 4. Summing up Neelam's net assets at the end of the day. All right, so at the end of the day on July 3rd, Neelam's total net assets are $2,750. This amount is made up of two pieces. 1. Capital introduced. This is the original $2,500 Neelam had put into the business at the start of the day. 2. Retained profit. This is the $250 in profit that her business earned during the day. So, when we add it all together, total net assets at the end of the day are $2,750. This includes $2,500 of capital plus $250 of retained profit. Key takeaways from Neelam's example. This example shows us some important things about how net assets work in a business. 1. Net assets represent the owner's stake. At any point in time, a business's net assets represent the capital the owner has put in, plus any retained profit the business has earned over time. For Neelam, at the beginning of the day, her net assets were $2,500. This was all capital with no retained profit yet, because she hadn't earned any profit for that day yet. 2. Increases in net assets represent profits earned. When net assets go up, this increase represents profit earned by the business during that period. For Neelam, the increase of $250 from the beginning to the end of the day represents the profit her business earned on July 3rd. 3. Total net assets combine capital and retained profit. By the end of the day, her total net assets reflect both the original capital she put in and the retained profit her business has earned. This section introduces the concept of drawings, or money that an owner takes out of their business for personal use. We'll continue following the example of Neelam Sultan and see how this affects the financial position of his business. What are drawings? In accounting, drawings are amounts of money that an owner takes out of the business for personal use. This isn't considered a business expense, but rather a reduction in the owner's equity in the business. Drawings reduce the business's cash or other assets, and as a result, they also reduce the total capital or net assets of the business. Step 1. Neelam Sultan decides to make a withdrawal. Let's look at what happened. Neelam Sultan earned a profit of $250 on her first day of business from selling flowers and other items. Feeling pleased with her day's work, she decides to take $180 out of the business to cover her living expenses. Neelam thinks of this as wages for herself, as a fair reward for the work she put in that day. However, since Neelam is the owner of the business, we handle this money differently than we would if it were a regular employee's wages. In accounting, this $180 is treated as drawings rather than as a business expense. This means that it's a withdrawal of profit by the owner, not an expense that reduces the business's profit. Step 2. Avoiding the incorrect way to calculate profit. Let's look at an incorrect way to calculate the business's profit to understand why drawings aren't treated as an expense. If we incorrectly treated the $180 that Neelam took out as an expense, it would look something like this. Profit from sales, $250. Minus wages or drawings for Neelam, $180. Resulting profit, $70. Incorrect. In this setup, it looks like the business only earned a profit of $70, which is misleading. The true profit earned by the business is still $250 because that's the amount of surplus the business generated from sales. The amount that Neelam took out is a personal withdrawal and doesn't affect the business's actual profit. Step 3. Correctly calculating profit with drawings. To show the correct way to handle this, we'll start by showing the business's total profit and then subtract Neelam's drawings separately to see what remains in the business. Here's how we would do it. Profit earned by the business, $250. Minus amount withdrawn by Neelam, drawings, $180. Profit retained in the business, $70. This setup shows that the business still earned $250 in profit, but after Neelam took out $180 as drawings, only $70 remains in the business. That $70 is now the retained profit, the profit that stays in the business and increases Neelam's equity in it. Step 4. How drawings affect the accounting equation. Let's look at how this affects the overall financial position of the business. Adjusting the assets. Since Neelam took out $180 in cash, the business's cash balance is now lower. Here's how the business's assets look after the drawings. Stall equipment is valued at $1,800. Flowers and plants, the inventory, are now valued at $0 since they were sold. Cash on hand is now $770, down from $950 after taking out $180 as drawings. So, the total assets of the business are now $2,570. Adjusting the capital side. On the capital side, we see how the drawings impact the owner's equity or net assets. Here's how it breaks down. Capital introduced by Neelam at the beginning, $2,500. Profit earned by the business on July 3rd, $250. Less drawings, amount taken out by Neelam, $180. After subtracting the drawings, we end up with a total capital of $2,570, which matches the total assets of the business. Step 5. Understanding the change in net assets. Now, let's focus on the increase in net assets since the business started operating. Originally, Neelam's capital in the business was $2,500. After earning $250 in profit and then taking $180 as drawings, the net increase in her capital, or net assets, is now $70. So, the retained profit in the business, meaning the profit that remains in the business after drawings, is $70. This is the true increase in net assets since trading operations began. Key points to remember. 1. Drawings reduce cash but not profit. When an owner takes money out of the business for personal use, it reduces the cash or other assets of the business, but it does not reduce the business's profit. Profit is still based on what the business earned, not on what the owner took out. 2. Drawings reduce capital or net assets. When the owner withdraws money, it reduces the total capital or net assets of the business because it's money leaving the business that could have been retained and reinvested. 3. The accounting equation is adjusted to include drawings. We can restate the accounting equation to show that assets equal capital introduced plus earned profit minus drawings plus liabilities. In Neelam's case, there are no liabilities, so our equation here is simply assets equal capital introduced plus earned profit minus drawings. After accounting for the drawings, this equation balances out, showing that the total assets and total capital are both $2,570. By understanding these steps, we can see how drawings affect the business's financial position. Drawings reduce the amount of profit retained in the business, which can impact the growth of the owner's equity or net assets over time. However, they don't affect the business's profit, which remains the same regardless of how much the owner withdraws for personal use. Let's go through each part of this question together. The goal is to understand the dual effect of each transaction, meaning how each transaction affects at least two accounts. This idea is central to double entry accounting, where every action in a business has an equal and opposite reaction that keeps the accounting equation in balance. Each transaction here affects the business's assets, liabilities, or capital. Let's examine each scenario in a friendly, step-by-step way so it's clear for beginners. Transaction A. The business receives a loan of $5,000 from its bank. When a business takes out a loan, it gets cash, which is an asset. But now, it also has a new liability because it owes this money back to the bank. Here's how this transaction affects the accounts. Assets, cash, increase by $5,000 because the business receives cash. Liabilities increase by $5,000 because the business now owes the bank. So, in this case, cash goes up and liabilities go up by the same amount, keeping the accounting equation balanced. Transaction B. The business pays $800 cash to purchase goods for resale. In this scenario, the business is using cash to buy inventory, which it plans to sell later. This transaction affects two types of assets, cash and inventory. Here's what happens. Assets cash decrease by $800 because cash is being spent. Assets inventory increase by $800 because the business now owns goods it can sell. In other words, cash goes down and inventory goes up by the same amount. The total value of assets remains the same, but it's now split differently between cash and inventory. Transaction C. The proprietor takes $50 from the till for personal use. Here, Neelam, the business owner, or proprietor, is taking $50 from the business's cash to buy a birthday present. This is known as drawings, and it represents a personal withdrawal of cash by the owner. It reduces both the business's cash and the owner's capital. Assets, cash, decrease by $50 because the business is losing cash. Capital decreases by $50 because Neelam is taking personal funds out of the business, reducing her equity. To sum up, cash goes down and capital goes down by the same amount, reflecting the reduction in the owner's stake in the business. Transaction D. The business sells goods costing $300 at a profit of $140. In this transaction, the business is selling goods. The cost of the goods was $300, but the business made a profit, selling them for $440. the cost of $300 plus the profit of $140. This affects three accounts: cash, inventory, and capital. Profit. Here's how each account is affected. 1. Assets. Cash increased by $440 because the business receives this cash from the sale. 2. Assets, inventory, decrease by $300 because the goods are no longer in the business. They've been sold. 3. Capital profit increases by $140, which is the profit earned from the sale. So in this transaction, cash goes up by $440, inventory goes down by $300, and capital goes up by $140, the profit made on the sale. Transaction E. The business repays a $5,000 bank loan plus interest of $270. In this final transaction, the business is paying back the bank loan in full plus an additional $270 in interest. This affects cash, liabilities, and capital. Here's the breakdown. 1. Assets, cash, decrease by $5,270 because this is the total amount being paid out. $5,000 for the loan plus $270 for interest. 2. Liabilities decrease by $5,000 because the loan is now fully repaid, so the business no longer owes the bank this amount. 3. Capital decreases by $270 because the interest payment is a loss for the business. Interest is not an asset or liability. It's an expense that reduces the owner's equity or capital. To sum up, cash goes down by $5,270. Liabilities go down by $5,000, the loan amount, and capital goes down by $270, reflecting the loss from interest paid. Putting it all together, understanding dual effects. In each of these transactions, we can see the dual effects that keep the accounting equation in balance. Let's quickly recap the key principles demonstrated in these examples. 1. Every transaction affects at least two accounts, either on the asset side, liabilities side, or capital side of the accounting equation. 2. Drawings reduce both assets and capital because they represent money taken out by the owner for personal use, not an expense of the business. 3. Purchasing inventory involves shifting value within assets. Cash decreases, but inventory, another asset, increases. 4. Repayment of a loan reduces both liabilities and cash, while interest payments are treated as an expense that reduces capital. 5. Profit from sales increases capital, reflecting the owner's equity increase from earning income. These examples help show how accounting records the flow of money and value in a business, capturing how each decision affects the financial health of the company. Keeping track of these dual effects is essential for accurate financial reporting and gives owners like Neelam a clear picture of their business's financial position. Welcome to today's lecture. Good day, everyone. I'm glad to see you all here and ready to dive into another key topic in accounting. Today, we're talking about accounts payable and accounts receivable. These are two super important concepts that come up whenever a business handles credit transactions. Before we jump in, let me set the stage for why this is worth your attention. Why should you care about this? First of all, this is something that will absolutely show up in your exams. You'll be expected to know what accounts payable and accounts receivable are, how they're recorded, and how they relate to the accounting equation. It's not just about memorizing definitions. You need to understand how these work in real-life scenarios. But it's not just for exams. Whether you end up managing a business, working in finance, or just handling your own accounts, understanding these concepts will make your life so much easier. So let's dig in. Take some notes and feel free to ask me questions if anything isn't clear. Let's start with the basics. What are credit transactions? When we talk about credit transactions, we mean situations where payment doesn't happen right away. Instead, the business or the customer agrees to settle the amount later. Think of it like a promise. You either owe money to someone, That's accounts payable. Or someone owes money to you. That's accounts receivable. This promise forms the basis of these two accounts. Easy enough so far, right? What is accounts payable? Okay, let's focus on the first type, accounts payable. This comes into play when a business buys goods or services on credit. Picture this. You run a flower shop and you need to stock up on vases. Your supplier delivers the vases to you, but instead of paying them immediately, you agree to pay next month. That unpaid amount is what we call accounts payable. Here's why it's important. Accounts payable is recorded as a liability in your books. Why? Because it's money you owe. It's an obligation. Once you pay your supplier, the amount gets cleared. Your cash balance decreases and the liability disappears from your records. Think of accounts payable like a financial IOU. Until you pay it off, it's a reminder that your business has a debt to settle. What is accounts receivable? Now let's flip the script. This time, imagine your flower shop sells $500 worth of flowers to a customer. But instead of paying up front, the customer says, "I'll pay you next week." That $500 becomes your accounts receivable. Why? Because it's money that's owed to you. Your business provided a service or product, so you're entitled to collect that payment. Here's the key to remember. Accounts receivable is recorded as an asset. Why? Because it represents money that will eventually come into your business. It adds value. Once the customer pays you, your cash balance increases, and the accounts receivable is cleared from your books. It's like the reverse of accounts payable. Instead of owing someone, someone owes you. How are they different? Let me put it in simpler terms. If your business owes money, that's accounts payable. If someone owes money to your business, that's accounts receivable. Payable equals money going out. Receivable equals money coming in. The biggest difference is how they're recorded in your books. Accounts payable is a liability because it represents money you owe to others. Accounts receivable is an asset because it represents money owed to you. Let's use a quick example. Let's stick with our flower shop example to see how this works. Imagine you buy $200 worth of flower pots from a supplier on credit. You haven't paid yet, so this creates an accounts payable of $200. It's recorded as a liability because it's money you need to pay. When you pay the $200, your cash decreases, and the accounts payable is cleared. Now, let's say you sell $500 worth of flowers to a customer on credit. The customer hasn't paid yet, so this creates an accounts receivable of $500. It's recorded as an asset because it's money you expect to collect. When the customer pays the $500, your cash increases and the accounts receivable is cleared. Easy enough? You're either paying someone or getting paid. It's all about keeping track of the timing. Why does this matter in the exam? Here's where it ties into your exams. You'll often be asked to calculate values related to accounts payable and accounts receivable, or figure out how they fit into the accounting equation. Remember this. The basic accounting equation is assets equals capital plus liabilities. Accounts receivable affects the assets side because it adds value to your business. Accounts payable affects the liabilities side because it's something your business owes. If you can understand how these two fit into the equation, you'll be prepared for any related question. Final thoughts. Before we wrap up, let me remind you why this is important. These concepts are central to how businesses track money coming in and going out. They help you keep your finances organized and balanced. And yes, they'll show up in your exams, so mastering them now will make your life easier later. So as you study, keep asking yourself, is this something the business owes, or is it something owed to the business? An account payable is a person or a business that a company owes money to because it purchased something on credit. That's it. It's that straightforward. For example, imagine you run a flower shop. You buy a bunch of potted plants from a supplier, but decide to pay for them later. In this case, the supplier becomes your account payable. From an accounting perspective, accounts payable is always recorded as a liability. Why? because it represents money your business is obligated to pay in the future. It's a debt, plain and simple, and accounting helps you track it so you don't lose sight of your financial commitments. Let's talk about trade accounts payable. Now here's a term you'll hear often in accounting: trade accounts payable. It sounds fancy, but it's just a specific type of account payable. These are debts that arise directly from the business's trading activities, basically the things you buy to keep your business running. Let me give you a few examples of what might fall under trade accounts payable. Materials you need to create products, components for assembling goods, items you purchase to resell, like flowers or gift items in a shop. So, going back to our flower shop example, if you buy flowers from a wholesaler to sell to your customers, the money you owe to the wholesaler is a trade account payable. It's directly tied to your business operations, unlike, say, a loan you might take out for equipment. That would fall under a different category of liability. The role of credit terms in business. Now let's talk about something that's a common practice in business: credit terms. When you buy on credit, you and your supplier agree on a specific date by which you'll make the payment. This arrangement is helpful because it allows you to get the goods or services you need right away without spending your cash immediately. Here's how it typically works. The supplier delivers the goods and sends an invoice with a payment deadline. The deadline might be something like 30 days from the purchase date, or even 2 or 3 months. This is a win-win situation. You get time to manage your cash flow, and the supplier knows exactly when they'll receive their payment. Let's walk through a real-life example. To make this crystal clear, let's go over the example from your book. The transaction. Company A buys goods from Company B for $2,000 on credit. Company B sends an invoice dated March 1st, which says payment is due in 30 days. What happens if payment is delayed? If Company A doesn't pay until March 31st, Company B remains an account payable for Company A during this time. How is this recorded? This part is where the accounting comes in. For Company A, the $2,000 they owe is recorded as an accounts payable in their books because it's a liability. For Company B, the same $2,000 is recorded as an accounts receivable because it's money they expect to receive. It's an asset for them. Why are accounts payable so important in business? Let's step back for a moment and talk about why accounts payable matter so much. These aren't just numbers in a ledger. They're tools for managing your business effectively. Helps manage cash flow. Think about it. By delaying payments to suppliers, a business can use its available cash for other things, like paying salaries, covering rent, or even investing in growth opportunities. Accounts payable essentially act as a short-term loan from your suppliers, giving you breathing room to manage your finances. Maintains good supplier relationships. Here's another important point. Paying your suppliers on time is crucial for building trust. Suppliers are more likely to offer favorable terms and continue doing business with you if they know you're reliable. That's why staying on top of your accounts payable is a must for any business owner. A quick note on invoices. Finally, let's touch on something we'll dive deeper into later: invoices. An invoice is basically a bill that the supplier sends you, showing how much you owe and when payment is due. Invoices are the backbone of tracking accounts payable because they provide all the details, like the amount, the due date, and even any penalties for late payment. We'll talk more about invoices in an upcoming chapter, but for now, just remember that they're a critical tool for managing accounts payable. What is accounts receivable? Let's start with the basics. Accounts receivable refers to the money that a person or another business owes to your business because they bought something from you on credit. It's what you're waiting to collect after you've already provided goods or services. Think of it this way. If you sell something to a customer but let them pay later, the amount they owe you is called accounts receivable. Here's why it's important. Accounts receivable is considered an asset in accounting. Why? Because it's money your business expects to receive in the future. Even though you don't have the cash yet, your right to collect it makes it valuable to your business. What about trade accounts receivable? Now let's get more specific. A trade account receivable is a type of accounts receivable that comes directly from your business's normal day-to-day operations. For example, if you run a flower shop and sell flowers on credit to a customer, the money they owe you is a trade account receivable. It's tied to the main business activity, selling goods or services. This is different from other types of receivables, like if someone owed you money for renting a piece of equipment. That's not tied to your regular business activities, so it wouldn't be classified as a trade account receivable. Why is accounts receivable considered an asset? Let's make this crystal clear. In accounting, an asset is something valuable that your business owns. Even though the money from accounts receivable hasn't landed in your bank account yet, it's still considered an asset. Why? Because you have a legal right to collect that payment. It's something of value to your business. So, when you look at a balance sheet, accounts receivable will always appear under the assets section, right alongside things like cash and inventory. Let's walk through a real-life example. Here's a practical example straight from your book to help you see how accounts receivable works. The sale on credit. Business C sells goods worth $6,000 to customer D. The terms of the sale specify that the payment is due in 2 months. The invoice is dated October 1st, so the due date is November 30th. What happens next? Between October 1 and November 30, the $6,000 will be recorded in Business C's books as accounts receivable. If customer D doesn't pay by November 30th, the $6,000 will remain as accounts receivable until it's settled. Recording it in the books. Here's how it's handled in accounting. For Business C, the $6,000 recorded as an asset under accounts receivable because it's money the business expects to receive. For customer D, the same $6,000 is recorded as a liability in their books because it's money they owe. Notice how these two sides match up? What's an asset for one business is a liability for the other. Comparing accounts receivable to accounts payable. Now, let's take a moment to compare accounts receivable to accounts payable. These two concepts often come up together, so it's important to see how they're different. Definition. Accounts receivable is money owed to your business by customers. Accounts payable is money your business owes to suppliers. Type of account. Accounts receivable is an asset because it's money you expect to receive. Accounts payable is a liability because it's money you're obligated to pay. Examples. Selling goods on credit creates accounts receivable. Buying goods on credit creates accounts payable. Where they appear. Accounts receivable shows up on the assets side of the balance sheet, while accounts payable appears on the liabilities side. Key points to remember about accounts receivable. Let's wrap this up with a few important points about accounts receivable. These are things to keep in mind for exams and for real life. Why does it happen? Businesses often allow customers to buy on credit because it makes it easier for customers to purchase. This can increase sales, which is great for the business. However, it also means the business has to wait to receive payment. Risks involved. Here's the tricky part. If customers don't pay on time, or worse, don't pay at all, the business could face cash flow issues. That's why keeping a close eye on accounts receivable is critical. Many businesses set up systems to remind customers about payments and follow up regularly. Connection to credit transactions. Remember, accounts receivable is part of a larger system of credit transactions. Just like a business buys goods on credit, creating accounts payable, it can sell goods on credit, creating accounts receivable. Both are normal and common in business operations. I know charts can sometimes feel overwhelming, but don't worry. I'll walk you through it step by step, as if we're having a one-on-one conversation. By the end of this, you'll clearly understand the key differences between accounts receivable and accounts payable, and how they're tied to a business's operations. Let's get started. Credit transactions. What's the big picture? This chart explains two common types of transactions that happen when a business deals with credit. 1. Sales on credit, which lead to accounts receivable. 2. Purchases on credit, which lead to accounts payable. These are opposites, but they're two sides of the same coin. One involves money a business is waiting to receive, and the other involves money a business owes. Now let's break it down column by column. First column, sales on credit. When a business sells goods or services to a customer on credit, the customer doesn't pay right away. Instead, they agree to pay later. Here's how that works, step by step. 1. What happens? The business makes a sale. The customer gets the goods or services but delays payment. For example, imagine a flower shop sells $500 worth of flowers to a customer and lets them pay after 30 days. That's a sale on credit. 2. What does this create? This transaction creates an accounts receivable. An accounts receivable is the money owed to the business by the customer. Think of it as a promise of payment that hasn't been fulfilled yet. 3. How is it recorded? In accounting, accounts receivable is recorded as an asset. Why? Because it represents money that the business expects to receive in the future. It's something valuable that adds to the business's worth. 4. When is it settled? This account is settled when the customer pays the money they owe. At that point, the business's cash increases and the accounts receivable decreases. Second column, purchases on credit. Now let's flip to the other side. What happens when a business buys goods or services on credit? Here's the process. 1. What happens? The business buys goods or services from a supplier. Instead of paying immediately, the business agrees to pay later. For example, imagine the same flower shop purchases $300 worth of flower pots from a supplier, but decides to pay the supplier after 60 days. That's a purchase on credit. 2. What does this create? This creates an accounts payable. An accounts payable is the money the business owes to the supplier. It's essentially a promise to pay the supplier at a later date. 3. How is it recorded? In accounting, accounts payable is recorded as a liability. Why? Because it represents money the business is obligated to pay. It's a debt. 4. When is it settled? This account is settled when the business pays the supplier. At that point, the cash decreases and the accounts payable is removed from the books. Key comparison between accounts receivable and accounts payable. Now that we've gone through each side of the chart, let's summarize the main differences. Sales versus purchases. Accounts receivable comes from sales made by the business. Accounts payable comes from purchases made by the business. Who owes whom? Accounts receivable is money owed to the business by customers. Accounts payable is money owed by the business to suppliers. Type of account. Accounts receivable is an asset because it represents money the business expects to receive. Accounts payable is a liability because it represents money the business is obligated to pay. How they're settled. Accounts receivable is settled when the business receives cash from customers. Accounts payable is settled when the business pays cash to suppliers. Why does this matter? Understanding these two types of accounts is crucial because they reflect how businesses handle cash flow. Here's why. Accounts receivable shows the money coming in. It's a measure of what the business is waiting to collect from customers. Accounts payable shows the money going out. It's a measure of what the business owes to others. Both are a natural part of running a business. Balancing them effectively helps ensure the business has enough cash to operate smoothly. That's it. This chart is a handy tool to keep in mind as you study or manage real-life accounting scenarios. If you have questions or want more examples, let me know. Let's keep building your confidence with these concepts. And let's revisit this question about Jackie Dixon and her business. This example is all about understanding how the accounting equation works and how we classify different amounts in Jackie's situation. Let's take it one step at a time. Here's the situation. Jackie has a total of $2,500 of capital invested in her business. Out of this, $1,750 came from Jackie herself, while the remaining $750 is a loan from Barry Grant. The question is, how does this affect the accounting equation? Before we dive into the solution, let's quickly review the accounting equation. Assets equals liabilities plus capital. This equation is the foundation of accounting. Everything the business owns, its assets, must balance with everything it owes, its liabilities, and the owner's investment, its capital. Step-by-step explanation. Step 1. Identify the assets. The first thing we need to figure out is what the business owns. In this case, the business has cash worth $2,500. That's the total value of its assets. Step 2. Break down the liabilities and capital. Now let's figure out how this $2,500 is balanced. It's a mix of liabilities, debts the business owes, and capital, money Jackie has invested as the owner. Jackie's contribution. Jackie invested $1,750 into the business. This amount is classified as capital because it represents the owner's claim on the business's assets. Loan from Barry. The remaining $750 is money the business borrowed from Barry. But here's the important question. How should we classify this? The classification depends on the terms of the agreement between Jackie and Barry, which we'll explore next. Step 3. Understand Barry's role. Barry's $750 could be classified in one of two ways, depending on the arrangement between him and Jackie. Scenario 1. Barry is a partner. If Jackie and Barry are partners in the business, meaning they share the risks, rewards, and profits, then Barry's $750 would be considered capital. Why? Because as a partner, Barry has a stake in the business, just like Jackie. In this case, Jackie's $1,750 and Barry's $750 are both classified as capital. There are no liabilities in this scenario because all of the money comes from the business's owners. So, the equation would look like this. Assets equals capital plus liabilities. Cash worth $2,500 equals capital worth $2,500 plus zero liabilities. Scenario 2. Barry is a lender. On the other hand, if Barry is simply lending the money and has no share in the business's profits, then the $750 would be classified as a liability. Why? Because the business is obligated to repay Barry, likely with interest. In this case, Jackie's $1,750 remains as capital. Barry's $750 is classified as a liability. Now, the equation would look like this. Assets equals capital plus liabilities. Cash worth $2,500 equals capital worth $1,750 plus liabilities worth $750. Final classification. Here's a summary of how the amounts are classified, depending on Barry's role. If Barry is a partner, assets, $2,500. Capital, $2,500, $1,750 from Jackie plus $750 from Barry. Liabilities, 0. If Barry is a lender, assets, $2,500. Capital, $1,750. Jackie's contribution. Liabilities, $750. Barry's loan. Key takeaways. Let's highlight the key points from this example. 1. The accounting equation must always balance. No matter how the money is classified, the total assets of $2,500 are always equal to the total liabilities and capital. 2. Classification depends on agreements. Barry's role determines whether the $750 is classified as capital if he is a partner or a liability if he is a lender. 3. Capital is a special liability. Jackie's $1,750 is classified as capital. In accounting, this is considered a special type of liability because the business technically owes it back to Jackie as the owner. And that's how we solve this question. That wraps up today's discussion. As always, feel free to ask questions if something isn't clear. Thanks for being such an attentive audience. I know this stuff can seem tricky at first, but the more you practice, the easier it gets. Let's keep building on these concepts together. Double entry bookkeeping, a friendly explanation. Double entry bookkeeping is the backbone of accounting. It's the system that ensures every financial transaction is recorded accurately by balancing two sides, a debit on the left and a credit on the right. The idea is simple. Every transaction affects at least two accounts, and the total amount of debits must always equal the total amount of credits. This keeps your accounts balanced and in line with the accounting equation. Assets equals liabilities plus equity. Key principles of double entry bookkeeping. For every transaction, 1. You'll make at least one debit entry on the left-hand side. 2. You'll also make at least one credit entry on the right-hand side. 3. The total debits and total credits for each transaction will always be equal. Understanding debits and credits. Debit, left side. A debit can represent any of the following. An increase in an asset. For example, buying office furniture increases your assets, so it's recorded as a debit. An increase in an expense. Paying rent or wages increases your expenses, which is a debit. A decrease in a liability. For instance, paying off a loan reduces your liabilities, so it's recorded as a debit. Credit, right side. A credit can represent any of the following. An increase in a liability. If you borrow money, your liabilities increase, and this is recorded as a credit. An increase in income. Making a sale increases your income, which is a credit. A decrease in an asset. When you pay cash, your cash asset decreases, so it's recorded as a credit. Why is double entry bookkeeping important? The double entry system ensures that your financial records are accurate and complete. By recording both the cause and effect of a transaction, it helps to maintain balance in your books, provide a clear trail of financial activities for auditing and reporting, ensure the accounting equation is always accurate. Exam tip: practice and memorize. For your exams and future studies, remember to practice identifying the debit and credit effects for various transactions. This system forms the foundation of everything you'll learn in accounting. The exam focus point reminds you that being confident with these rules is crucial for success in A1 and beyond. The dual effect of a business transaction. The concept of the dual effect is a cornerstone of accounting and is essential to understanding the double entry bookkeeping system. The idea is simple, yet powerful. Every business transaction affects two accounts, keeping the accounting equation balanced at all times. Whenever a transaction occurs, if one side of the equation changes, the other side must change in a way that keeps the balance intact. This is why the double entry system requires recording every transaction in two parts, one as a debit, left side, and the other as a credit, right side. How dual effect works. The dual effect ensures that every financial activity is accurately reflected in the books. Let's take an example to illustrate this. Example: a business pays $50 in cash for goods. When the business buys goods for $50 and pays in cash, what happens to the cash? The cash, an asset, decreases by $50. What happens to the inventory? The value of goods in inventory, also an asset, increases by $50. In this case, 1. Cash decreases, credit. 2. Inventory increases, debit. The total value of assets remains unchanged, but the composition of the assets has shifted. This shows how one transaction can impact two different accounts. Double entry bookkeeping system. This system is called double entry because it ensures every transaction is recorded twice, once as a debit, left side, and once as a credit, right side. Here's why it works. 1. Every transaction has two sides. Something is gained and something is given up. 2. The total value of debits is always equal to the total value of credits. Key points to remember. 1. Every transaction has a dual effect. It impacts at least two accounts. One is debited and the other is credited. 2. The equation stays balanced. Changes in assets, liabilities, or capital are always equal on both sides. 3. Double entry ensures accuracy. It prevents errors and creates a clear audit trail. By understanding the dual effect, you'll see that accounting is not just about recording numbers, but about maintaining balance in the financial position of a business. All right, let's break this chart down in a simple and friendly way so it's easier to understand. Understanding debits and credits. In accounting, every transaction is recorded in a ledger account, and these accounts have two sides. Debit on the left-hand side, which represents what the business owns or receives. Credit on the right-hand side, which represents what the business owes or gives. The type of account and the nature of the transaction determine which side, debit or credit, is affected. Let's walk through what each means in practical terms. What happens on the debit side? The debit side is all about things the business owns, gains, or spends. Here's when you would use the debit side. 1. An asset increases. For example, if you buy new office furniture, the value of your assets, furniture, increases. This goes on the debit side. 2. A liability or capital decreases. If you pay off an account payable, a liability, the liability decreases, so you would record this as a debit. 3. Income decreases. If you cancel a sale or give a refund, your income decreases, so you would debit the account. 4. An expense increases. For example, if you spend money on advertising, this is an expense, and it would go on the debit side. What happens on the credit side? The credit side is all about what the business owes, gives, or earns. Here's when you would use the credit side. 1. An asset decreases. For example, if you pay cash for something, your cash decreases. This would be recorded on the credit side. 2. A liability or capital increases. If you buy goods on credit, your liabilities increase, so you would record this as a credit. 3. Income increases. When you make a sale, your income increases, so you record this on the credit side. 4. An expense decreases. If you cancel an expense, like reversing a purchase, the expense decreases, so it goes on the credit side. Key takeaway: the debit and credit sides are like a balancing act. For every action, debit, there's an equal and opposite reaction. Credit. That's what keeps your accounts accurate and your financial records balanced. What is a ledger account? A ledger account is essentially a detailed record where all the transactions related to a specific item are tracked. These items can include assets, like cash or machinery, liabilities, like loans or payables, income, like sales, or expenses, like rent or wages. The ledger account keeps a clear record of every transaction, showing how much money is coming in, going out, and what it's for. Each ledger account is split into two sides. The left side, known as the debit side, records increases in assets or expenses and decreases in liabilities, equity, or income. The right side, known as the credit side, records increases in liabilities, equity, or income, and decreases in assets or expenses. Why is it called a T account? If you look at the structure of a ledger account, it resembles the shape of the letter T. The name of the account is written at the top, and the two sides, debit on the left and credit on the right, are positioned below. This simple layout makes it easy to visually separate and organize transactions into debits and credits. How is a cash transaction recorded in a ledger account? Now let's dive into how cash transactions are recorded using the T account format. Remember, the double entry bookkeeping system ensures that every transaction has two sides, a debit and a credit, and they must balance. This example shows how various transactions are recorded in the ledger accounts using the double entry bookkeeping method. Transaction A, a cash sale of $2. What happens? The business makes a sale and receives cash immediately. This increases both the cash account and the sales account. 1. Cash account, asset. When the business receives cash, the cash account increases. Assets increase with a debit. 2. Sales account, income. At the same time, the business earns revenue. Income increases with a credit. Recording in ledger accounts: bank general ledger account, cash, debit $2. Sales account, credit $2. Transaction, B. Payment of a rent bill of $150. What happens? The business pays rent. This reduces its cash balance and increases its rent expense. 1. Cash account asset. Paying rent decreases the cash account. Assets decrease with a credit. 2. Rent expense account. The rent expense increases because the business incurred the cost. Expenses increase with a debit. Recording in ledger accounts. Bank general ledger account. Cash. Credit $150. Rent account. Debit $150. Transaction C. Buying goods for $100 in cash. What happens? The business purchases inventory using cash. This reduces cash but increases purchases. An expense account. 1. Cash account asset. Cash decreases because it was used to pay for the goods. This is recorded as a credit. 2. Purchases account. The purchases account increases to reflect the cost of the goods. Expenses increase with a debit. Recording in ledger accounts. Bank general ledger account. Cash. Credit $100. Purchases account. Debit $100. Transaction D. Buying shelves for $200 in cash. What happens? The business buys shelves, which are considered a non-current asset. Cash decreases, but the shelves account, another asset, increases. 1. Cash account asset. Cash decreases because it was used to pay for the shelves. This is recorded as a credit. 2. Shelves account asset. The shelves account increases to reflect the purchase. Assets increase with a debit. Recording in ledger accounts. Bank general ledger account. Cash. Credit $200. Shelves account. Debit $200. Summary of the bank general ledger account. After recording all 4 transactions, the cash account would look like this. Bank general ledger account. Cash. Debit side, left. $2 for the cash sale. Credit side, right. $150 for rent payment. $100 for the purchase of goods. $200 for the purchase of shelves. Net effective transactions on the cash account. To determine the final balance in the cash account, add all the amounts on the debit side, only $2. Subtract all the amounts on the credit side, $150, $100, and $200. This shows the total reduction in the business's cash balance after these transactions. This detailed explanation should help all students, including beginners, see how each cash transaction is recorded in the ledger and how the debit and credit system works for each account. This solved question shows how to record cash transactions in Ledger T accounts using the double-entry bookkeeping system, where each transaction affects at least 2 accounts. One account is debited, recorded on the left side, and another is credited, recorded on the right side. Let's break down each transaction clearly and in a way that's easy to understand. Transaction A, a cash sale worth $60. The business sells goods and receives $60 in cash. Here's what happens. 1. Cash and asset increases because the business gets $60. This is recorded as a debit in the bank general ledger account. 2. Sales, income, increases because the business earns $60 from selling goods. This is recorded as a credit in the sales account. How it's recorded in the ledgers. Bank general ledger account, debit, $60 from the sales account. Sales account, credit $60 to the bank general ledger account. Transaction B, payment of a rent bill totaling $4,500. The business pays $4,500 for rent. Here's what happens. 1. Cash and asset decreases because the business pays $4,500. This is recorded as a credit in the bank general ledger account. 2. Rent and expense increases because rent is a business expense. This is recorded as a debit in the rent account. How it's recorded in the ledgers. Bank general ledger account. Credit, $4,500 to the rent account. Rent account. Debit, $4,500 from the bank general ledger account. Transaction C, buying goods for cash at $3,000. The business purchases goods for $3,000 in cash. Here's what happens. 1. Cash, an asset, decreases because the business spends $3,000. This is recorded as a credit in the bank general ledger account. 2. Purchases, an expense, increases because the business acquires goods for resale or use. This is recorded as a debit in the purchases account. How it's recorded in the ledgers: bank general ledger account, credit $3,000 to the purchases account. Purchases account, debit $3,000 from the bank general ledger account. Transaction D, buying shelves for cash at $6,000. The business buys shelves for $6,000. Here's what happens. 1. Cash, an asset, decreases because $6,000 is paid. This is recorded as a credit in the bank general ledger account. 2. Shelves, an asset, increase because the business now owns new shelves. This is recorded as a debit in the shelves account. How it's recorded in the ledgers: bank general ledger account, credit $6,000 to the shelves account, shelves account, debit $6,000 from the bank general ledger account. Summary of the bank general ledger account. When all 4 transactions are summarized, the bank general ledger account looks like this. 1. Debit side, cash received, $60 from the sale. 2. Credit side, cash paid out, $4,500 for rent, $3,000 for goods purchased, $6,000 for shelves purchased. This shows the cash inflow debit and cash outflow credit, maintaining the balance in the ledger. Recording credit transactions in ledger accounts. When businesses make transactions, not all of them are settled immediately in cash. Some transactions are conducted on credit terms, meaning the payment will be made or received at a later date. These credit transactions require additional accounts in the ledger, such as trade receivables for money owed to the business and trade payables for money the business owes. Let's break this down step by step so everyone can understand. Key points about credit transactions. 1. What are credit terms? When a business sells goods or services but doesn't receive payment immediately, the amount owed by the customer is recorded as trade receivables. Similarly, when a business purchases goods or services on credit, the amount it owes to the supplier is recorded as trade payables. 2. Why not record it directly in the bank account? Since no cash changes hands at the time of the transaction, you cannot immediately record it in the bank general ledger account. Instead, you use trade receivables or trade payables to track the money owed. 3. The double entry principle still applies. Each transaction affects 2 accounts. One account is debited and another is credited to ensure the books remain balanced. 4. When cash is finally paid or received, the credit balance in the trade receivables or trade payables account is cleared by recording the cash payment or receipt in the bank general ledger account. Examples of credit transactions. Let's look at the table in the attachment and explain how different types of credit transactions are recorded in ledger accounts. Example 1. Selling goods on credit. What happens? A business sells goods to a customer on credit, meaning the customer will pay later. For example, if a business sells goods worth $1,000, income, sales increases, so the sales account is credited. Assets, amount owed by the customer, increase, so the trade receivables account is debited. Entry in the ledger accounts. Trade receivables account, debit $1,000. Sales account, credit $1,000. Example 2, receiving cash from a customer. What happens? When the customer pays the money they owe, the amount is removed from the trade receivables account and added to the bank general ledger account. Cash, an asset, increases, so the bank general ledger account is debited. The receivable amount owed by the customer decreases, so the trade receivables account is credited. Entry in the ledger accounts. Bank general ledger account, debit $1,000. Trade receivables account, credit $1,000. Example 3, buying goods on credit. What happens? When the business buys goods from a supplier on credit, it records the expense in the purchases account. At the same time, the amount owed to the supplier is recorded in the trade payables account. Expenses, purchases, increase, so the purchases account is debited. Liabilities, money owed to the supplier, increase, so the trade payables account is credited. Entry in the ledger accounts. Purchases account, debit $500. Trade payables account, credit $500. Example 4. Paying a supplier. What happens? When the business pays the supplier, the liability, amount owed in the trade payables account is cleared and the cash is deducted from the bank general ledger account. Cash, an asset, decreases, so the bank general ledger account is credited. The payable, money owed to the supplier, decreases, so the trade payables account is debited. Entry in the ledger accounts. Trade payables account, debit $500. Bank general ledger account, credit $500. Understanding the net effect. The net result of these transactions is the same as a cash transaction. However, there's an additional time delay between the initial transaction, recorded in receivables or payables, and the final cash settlement, recorded in the bank account. These extra steps provide a clear record of what's owed to the business and what the business owes others. Let's break this question down step by step and explain why each transaction is recorded as a debit and credit. The goal is to ensure you understand how to apply the double entry system to record transactions in the ledger accounts. Transaction A. Bought a machine on credit from A. Cost $8,000. Explanation. The business now owns the machine, which is a non-current asset. Assets increase with a debit entry, so we debit the machine account. However, the business hasn't paid for the machine yet. It owes the supplier A. This increases the business's liabilities, recorded with a credit entry in the trade payables account A. Entry. Debit machine account for $8,000. Credit trade payables account A for $8,000. Transaction B. Bought goods on credit from B, cost $500. Explanation. The business purchased goods, which increases the purchases account, an expense account. Expenses increase with a debit entry. Since the goods were bought on credit, the business now owes the supplier B. This increases the trade payables account B, recorded with a credit entry. Entry. Debit purchases account for $500. Credit trade payables account for $500. Transaction C. Sold goods on credit to C, value $1,200. Explanation. The business sold goods, creating revenue. This increases the sales account, which is recorded with a credit entry. Since the customer, C, hasn't paid yet, they owe the business money. This is an asset, trade receivables account, which increases with a debit entry. Entry. Debit trade receivables account, C, for $1,200. Credit sales account for $1,200. Transaction. Paid D, a supplier, $300. Explanation. The business paid a supplier, reducing the cash balance. A reduction in assets, cash, is recorded with a credit entry in the bank general ledger account. At the same time, the business reduces its liability to the supplier, D. A decrease in liabilities is recorded with a debit entry in the trade payables account, D. Entry. Debit trade payables account, D, for $300. Credit bank general ledger account for $300. Transaction E. Collected $180 from E, a customer. Explanation. The business collected cash, which increases the cash balance. An increase in assets, cash, is recorded with a debit entry in the bank general ledger account. At the same time, the business reduces the amount owed by the customer, E. A decrease in assets, receivables, is recorded with a credit entry in the trade receivables account, E. Entry, debit bank general ledger account for $180. Credit trade receivables account, E, for $180. Transaction F. Paid wages of $4,000. Explanation. Wages are an expense which increases with a debit entry in the wages expense account. The payment reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry. Debit wages expense account for $4,000. Credit bank general ledger account for $4,000. Transaction G. Received rent bill of $700 from landlord. Explanation. The business now owes rent to the landlord, increasing the rent expense account, an expense. Expenses increase with a debit entry. At the same time, the amount owed increases the business's trade payables account, G. Liabilities increase with a credit entry. Entry. Debit rent expense account for $700. Credit trade payables account for $700. Transaction. Paid rent of $700 to landlord. Explanation. The payment reduces the business's liability to the landlord. A decrease in liabilities is recorded with a debit entry in the trade payables account, G. The payment also reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry. Debit trade payables account, G, for $700. Credit bank general ledger account for $700. Transaction I. Paid insurance premium of $90. Explanation. Insurance is an expense which increases with a debit entry in the insurance expense account. The payment reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry. Debit insurance expense account for $90. Credit bank general ledger account for $90. Thank you, everyone, for your attention and for staying with us throughout the lesson. If you found this explanation helpful, please support us by liking the video and subscribing to the channel so you don't miss out on future lessons. In our next session, we'll cover the last topic of Chapter 2, which is asset expenditure and expenses charged to profit and loss. It's an important concept, so don't miss it. Take care and see you in the next lesson. The subject we're talking about today is asset expenditure versus expenses charged to profit or loss. This is a critical concept because if these two are mixed up, it can lead to incorrect profit calculations, and that could mislead not just the business, but also investors, lenders, and anyone else relying on the financial statements. What are we really talking about? Every business spends money on different things. Some expenses are for short-term needs, like paying the utility bill or buying paper for the office printer. Other expenses are for long-term benefits, like purchasing a delivery van or upgrading machinery. When money is spent on long-term assets, things that help the business over multiple years, it's called asset expenditure. When money is spent on short-term necessities, things that are used up within the year, it's called expenses charged to profit or loss. The critical thing to understand is that these two types of spending are treated very differently in the accounts. Let's break them down. 1. What is asset expenditure? Asset expenditure is the money a business spends to buy or improve non-current assets. These are assets that the business will use over many years to help it generate income. Examples include machinery used to manufacture products, buildings, such as office spaces or warehouses, vehicles, like trucks or company cars. Think of asset expenditure as a long-term investment in the business. These assets won't just help the business this year. They'll continue to add value for many years. How is asset expenditure treated in accounts? 1. It's recorded as an asset on the balance sheet, not as an expense. For example, let's say the business buys a delivery van for $20,000. This amount will appear as an asset under vehicles in the balance sheet. 2. It is not deducted from income when calculating this year's profit. Why? Because the van will be used for many years, and its cost is spread out over those years using something called depreciation. Don't worry about depreciation for now. We'll cover it later in detail. 2. What are expenses charged to profit or loss? These are the costs a business incurs to operate on a daily basis. Unlike asset expenditure, these costs don't result in something the business will keep or use for years. Examples include utility bills, like electricity or water, office supplies, such as paper and ink, salaries paid to employees, repairs, like fixing a broken photocopier. Think of these as short-term costs, necessary to keep the business running, but not something that will last into future years. How are these expenses treated in accounts? 1. They are recorded in the income statement, also called the profit or loss statement. For example, if the business pays electricity bills totaling $1,000, this amount is recorded as an expense in the income statement. 2. They are deducted from income when calculating this year's profit. Why? Because they are costs of doing business during the current year. What happens if you mix them up? This is where things can go very wrong. If you confuse asset expenditure with expenses, your profit calculation will be incorrect. Here's how. 1. If asset expenditure is treated as an expense, your expenses will be overstated, too high. Your profit will be understated, too low. For example, if you treat the $20,000 cost of a delivery van as an expense instead of an asset, your profit will appear much smaller than it actually is. 2. If expenses are treated as asset expenditure, your expenses will be understated, too low. Your profit will be overstated, too high. For example, if you treat a $500 electricity bill as an asset instead of an expense, it will look like you've spent less money and your profit will appear artificially high. 3. An example to make it clear. Let's say a business buys 10 gadgets for $200, so each gadget costs $20. During the year, the business sells 8 of these gadgets. The cost of the 8 gadgets sold is calculated as 8 gadgets multiplied by $20 each, which equals $160. This $160 is recorded as an expense called cost of goods sold in the income statement for the year. The cost of the 2 remaining gadgets, which is $40, stays in the business as inventory. This is recorded as an asset on the balance sheet and carried forward to the next year. Why does this distinction matter? The key point is that asset expenditure is about long-term value, while expenses are about short-term costs. Mixing them up can lead to errors in the financial statements, and that can cause problems for decision-making. In summary, 1. Asset expenditure is money spent on long-term assets that will benefit the business for many years. These are recorded on the balance sheet and not deducted from this year's income. 2. Expenses charged to profit or loss are short-term costs incurred to keep the business running. These are recorded in the income statement and deducted when calculating profit. 3. Mixing them up can lead to either overstating or understating the business's profit, which can mislead users of the financial statements. If you have any questions, don't hesitate to ask. This topic is fundamental, and understanding it will help you build a solid foundation for everything we'll learn later. Let's understand the question. First, the question is asking us to do 2 things. 1. Understand what expenses charged to profit or loss are by completing a definition. These are costs for goods and services that the business uses up within the current accounting period. Things that are consumed or finished during the year. 2. Understand what asset expenditure is by filling in a definition. This refers to money spent on long-term assets that will help the business beyond just the current year. Both definitions are incredibly important because treating these costs correctly in the accounts ensures the business reports accurate profits. Answer and explanation. 1. Expenses charged to profit or loss. The correct completed definition is: expenses charged to profit or loss result from the purchase of goods and services that will be used fully in the accounting period in which they are purchased, and so become a cost or expense in calculating the profit for the period. Why is this the correct definition? Let's break it down. Goods and services used in the current period. These are short-term costs, meaning the business consumes them fully during the same accounting period they're purchased. Examples: electricity bills, stationery, or repairs. If you pay your electricity bill in January, that electricity is consumed immediately. It won't benefit the business next year. Charged as expenses to the profit or loss statement. Because these costs are for this year only, they are deducted when calculating the profit or loss for the year. Think of them as necessary costs for running the business day-to-day in this specific period. So, in simple terms, expenses charged to profit or loss are short-term costs used up during the same period they are incurred. 2. Asset expenditure. The correct, completed definition is: asset expenditure results in the purchase or improvement of non-current assets, which are assets that will provide benefits to the business in more than one accounting period and are not acquired to be resold as part of normal trade. Why is this the correct definition? Let's break this down. Non-current assets. These are long-term assets that the business will keep and use for many years, like machines, vehicles, or buildings. Examples: a business might buy a delivery truck or renovate its office space. These assets will help the business for multiple years. Not for resale. These assets are different from inventory or goods that the business buys to sell to customers. For example, if you buy office desks, you'll keep and use them for many years. These are non-current assets. But if you're a furniture store, the desks you buy are inventory. They'll be sold to customers in the normal course of business. Used over multiple periods. Non-current assets aren't consumed immediately. Instead, they help the business generate income for many years. For example, if a bakery buys a new oven, that oven might be used daily for 5 or more years to bake products. So, in simple terms, asset expenditure is about long-term purchases that support the business for years, not just the current accounting period. The key difference between the two, the distinction between expenses charged to profit or loss and asset expenditure, comes down to time and purpose. Expenses charged to profit or loss are short-term costs. The business uses them up entirely within the current accounting period, and they are included in the profit or loss calculation for the year. Think day-to-day running costs like salaries or utility bills. Asset expenditure involves long-term investments. The business purchases or improves assets that will provide value for many years, and these are recorded on the balance sheet as assets. Think investments in equipment, property, or vehicles. Let's take a close and clear look at the question and its answers to ensure we understand why each classification is correct. We'll approach this step by step and explain why each item is classified as asset expenditure, expenses charged to profit or loss, or income. Question recap. The question asks us to classify several items as either 1. Asset expenditure. Money spent on long-term assets that benefit the business beyond the current accounting period. 2. Expenses charged to profit or loss. Short-term costs fully consumed within the current year and deducted from income to calculate profit. 3. Income. Money earned by the business contributing to its revenue. Let's now go through each item and its answer in detail. Purchase of premises. Answer: asset expenditure. Explanation: why? Purchasing premises is a long-term investment for the business. Premises are non-current assets that the business will use for many years, possibly decades. This spending is not treated as a short-term expense because the premises are not used up in the current year. Instead, they remain an asset on the balance sheet and are gradually depreciated over time. B. Solicitor's fees in connection with the purchase of premises. Asset expenditure. Why? When purchasing premises, any additional costs incurred that directly relate to acquiring the asset, like legal fees, stamp duty, or transfer costs, are added to the cost of the premises. These fees are considered part of the total cost of acquiring the non-current asset and are therefore classified as asset expenditure. Costs of adding extra storage capacity to a mainframe computer used by the business. Answer: asset expenditure. Explanation: why? Adding extra storage to a mainframe computer is an enhancement to an existing non-current asset. It increases the value or capacity of the computer, allowing the business to benefit from the improvement for several years. This type of cost is treated as asset expenditure because it's a long-term improvement, not a maintenance cost or short-term expense. D. Computer repair and maintenance costs. Answer: expenses charged to profit or loss. Explanation: why? Repairs and maintenance are day-to-day operational costs that ensure the asset remains functional. They do not increase the value or lifespan of the computer. These are short-term expenses, fully consumed in the year they occur, and are deducted as expenses in the profit or loss statement. Profit on the sale of an office building. Income. Explanation: why? When the business sells an office building for more than its current book value, the excess amount profit is treated as income. This profit is recorded in the profit or loss statement as it contributes to the business's overall revenue for that year. F. Revenue from sales by credit card. Why? Revenue earned from selling goods or services, whether paid in cash or via credit card, is classified as income. This is money earned by the business during the current accounting period, and it directly contributes to the profit calculation. G. Cost of new machinery. Answer: asset expenditure. Explanation: why? Buying new machinery is a long-term investment. Machinery is a non-current asset that the business will use for many years to help generate revenue. The cost is recorded on the balance sheet under machinery and not immediately deducted as an expense. Instead, the cost will be depreciated over the asset's useful life. H. Customs duty charged on the machinery when imported into the country. Answer: asset expenditure. Explanation: why? Customs duty paid when importing machinery is considered part of the total cost of acquiring the asset. This is because the duty is a necessary cost to bring the machinery into the business's use. These costs are added to the value of the machinery on the balance sheet as they are directly linked to acquiring the non-current asset. I. Carriage costs of transporting the new machinery from the supplier's factory to the premises of the business. Answer: asset expenditure. Why? Transportation costs for delivering machinery to the business's premises are also considered part of the total cost of acquiring the asset. Just like customs duty, these costs are necessary to get the machinery ready for use and are added to the asset's value on the balance sheet. J. Cost of installing the new machinery in the premises of the business. Answer: asset expenditure. Why? Installation costs for new machinery are necessary to make the asset ready for use. These costs are treated as part of the asset's total cost and are included on the balance sheet under machinery. These costs are not recorded as short-term expenses because they contribute to the long-term usability of the asset. Wages of the machine operators. Answer: expenses charged to profit or loss. Explanation: why? The wages paid to machine operators are day-to-day operational costs. These wages are not related to the purchase, improvement, or setup of the machinery itself. They are considered short-term expenses incurred to operate the machinery during the current year, and they are deducted from income in the profit or loss statement. Thank you for watching. This was the final lesson from Chapter 2. Keep practicing to master the topic, and don't forget to like and subscribe to support us. See you in the next chapter.